Welcome to the podcast with Motilal Oswal. I'm Avan Dabash. Today we focus on how wealth is built, preserved, and compounded over time. We're joined by Ashish Shanker. He's the managing director and CEO of Motilal Oswal Private Wealth, which advises over 1.3 trillion rupees in assets. In this conversation, he offers us an inside look as to how some of India's wealthiest families actually invest their money, what his outlook is on equities, volatility, diversification, and long-term decision-making in a world that's filled with so much uncertainty. Thank you so much for joining in. Let's begin, Ashish. Ashish, I'm going to dive straight into it because you have said this on record hundreds of times before. 100% in equities, and you are a firm believer in that over the last 25 years. How has that strategy worked out for you, and why are you so strongly convinced that it's the strategy to go with?
Well, I have an unwavering faith in the Indian economy, and I have an unwavering faith that the next 10, 20 years will be even better than what we saw in the last 25 years.
Okay.
Of course, it's not an easy strategy to live by, and this is not something that I recommend to everybody.
Okay.
It's just that I have lived by this strategy in the last 25 years, and it's worked out extremely well. So I'll give you two anecdotes. I mean, when you start off in your career, obviously the capital that you can allocate to savings is very small, right? So the first drawdown I saw was in 2000. My portfolio fell almost 60-65%. And obviously there were a lot of doubts in my mind
Yeah,
whether
you
I'm
need to have the
doing.
stomach for that.
But I think what helped at that point in time was anyway the corpus was small, and I still had faith that things will come back. So I kept by that philosophy. And rightly so, by 2004, 2005, my portfolio had fully recovered. And by 2007-8, the portfolio was actually much, much higher than what I saw it in 2000. In 97, I started working, right? And one of my first roles was an analyst role in a brokerage house. And I'm talking about 97, right? Way back. So those time brokerages were really small. But I had put in some capital of mine, and I borrowed some money from my father. Now, he kept it in a joint account with my mom. Now, those shares were in physical form. Okay. Now, during COVID, I was just doing some cleanup, and I kind of went and got these shares dematted. And out of curiosity, I checked the value. So, the value at that time when I invested was about 85,000.
Okay.
You know what's the value today? It's about 1.25 crores. I had just forgotten about it.
Wow.
And that
The
really
money did all the talking.
defines the power of compounding. And it's not that I bought some great stocks,
Yeah.
right? I was starting off my career. There were stocks which went to zero. But the good ones not just made up for the bad ones, but they actually multiplied and gave a compounded IRR of about 20% plus.
So, if this is not for everyone, who is this strategy rightly suited for? If there was an investor coming to you saying, "Hey, maybe I'm open to this, but what do I need to make sure that I really am?"
Right. See, this works beautifully for people who are starting off their career
Okay.
and have some small corpus to start off with, and somebody who has regular cash flows.
Okay.
And typically, all of us as salaried professionals, we know the paycheck is coming at the end of the month. So after taking care of your expenses, you've got something left to save. And this is what I would urge everybody. The earlier you can start allocating some part of your salary towards savings, the better off you will be later on in your career. Because what you lose in the first 5 years, you cannot make it up
Yeah, and I think you
later
the
on.
point of the regular cash flows is very critical. Someone who doesn't have that kind of money
Correct.
cannot afford to burn their
Yes.
fingers.
And there are some small nuances
Sure.
which helped me stay the course. So I'll give you one more example,
Give
which
us all.
which a lot of people know about. I normally keep almost 6 to 9 months of my salary in my savings account as cash. Okay, I know it's
Okay.
a very inefficient way of allocating because your savings account, gives about 4.5%.
Huh.
However, given that bulk of my savings is in equities in a volatile asset class, this just gives me the comfort and the cover needed to stay the course, right? Over time, this becomes a very small part of your overall portfolio in terms of the cash And I just like it in my savings bank account because if you need liquidity for emergency purposes, you don't have to touch your core equity portfolio.
Okay. So that would be another criteria or something that you do that really works for you.
Correct.
You have the conviction that the India story is going to do better over the next 20 years than it has in the last 20 to 25 years. What is giving you that conviction?
See, we have all the ingredients, right? And you've seen economies emerge over long periods of time. I mean, I've been an avid reader from the time I was in college, and then, of course, after I started working, it intensified my reading process. So, if you look at most economies which have grown, including the US, right? There are three, four ingredients required for you to sustain growth.
Okay.
First is a young, productive population because you have that much working class coming into the economy. India is the youngest country today in terms of the working class population, right? Point number two, you can look at it as glass half full or a glass half empty. And this basically pertains to a lot of the things we see around us which irritate us, right?
Yeah.
You see potholes around you, you see that infrastructure is still very weak, but you look at it the other way, this is opportunity.
Okay.
Right? I mean, last 25 years, we've come a long way, right? Today, our airports look world class. The railway infrastructure has got upgraded. If you see the number of roads that we have built, connecting tier 2 towns, tier 3 towns, villages, right? Every road built brings in a lot of prosperity. It brings in a lot of growth. So, in the long run, it is population plus productivity is what is equal to GDP.
Okay.
The last thing is, as a country, we have such a large English speaking population. So our ability to connect with the world is amazing. And that probably was one of the key ingredients for us to develop the entire software services industry. Y2K was a big boon for our country. But I believe we could capture it because of the young technical working population. And secondly, our English speaking ability. And
Yes.
that creates the ability to connect with the world. So if you look at all these necessary ingredients for growth, I would say it's only gotten better over time. So that's the reason, I have so much conviction that the next 5, 10 years, of course, you will have your breaks in between,
Okay.
right? There will be global volatility. There will be self goals that we will do as an economy. All of those things we've seen in the past as well. But if you take a slightly longer lens, right, the next 5, 10, 15 years look probably the most exciting.
Okay.
And we've seen this unravel in other economies, right? Economies who've gone from, let's say, a $4 to $8 trillion economy or a $10 trillion. There are only two other economies which have done this, by the way,
Okay.
in the past. Okay, we'll be the third economy to travel this distance. The prosperity has been the most accelerated during this period, in whether it's US or whether it is China.
Okay, so that's glass half full. So you're saying you're not worried about things like tariffs, geopolitical risks, FIs pulling out. You're saying stay the course. These are bumps along the way. So for an investor, as we stepped into the new year, what are you advising that they do?
So look, last year was a bit of a tough year for equities, or I would rather say that we were running against our own expectations
Okay.
because 20 to 24 was so good that all of us started expecting that equities every year will
It's going to be a
deliver
one-way journey.
20-25%.
Yeah.
But that's not the case. The reason why equities gives higher returns is because you go through that volatility.
So was it much needed?
So it was much needed, I thought. There is a bit of an expectation reset. I think after 4 years of frenetic growth, we saw a little bit of slowdown in activity. Of course, there were a lot of factors like geopolitics, global tariffs, FIs pulling out money, valuations. Now, these are all reasons that when we look back in hindsight, we know why the markets were flat or very, very narrow. But I think we've gone through that consolidation phase, and 2026 as we start off looks very much more exciting than 2025 for equities, and we can
Yeah.
talk about some of the factors why I believe so.
Okay, so tell us what are the factors then?
So see, as you go into 2026, your prices have corrected or consolidated across a large number of stocks, right? So the argument that valuations are expensive, they're not as expensive as they were last year. Okay, point number one. Point number two, there is a bit of an earnings catch up as well. Even this year, we will see, if I take the larger market and the top 100 companies, you will see mid-teens kind of earnings growth, right? So a lot of stocks have corrected, let's say 10, 15, 20%, depending on which sector you look at. Earnings have gone up, let's say 10 to 15% in most cases. So actually valuations have corrected a good 25 to 30% as you enter 2026. So that valuation argument actually is weaker now. A lot of other countries which were looking more attractive, now I'm talking from an FI point of view, right? Now there is this narrative that FIs put more money into China, put more money into US, or allocated more to Europe because India was relatively looking expensive to them, right? Now that argument also becomes weaker because China has rallied 40%, US is having its best phase in tech led by the entire AI narrative. Europe, a lot of the defense stocks have moved up very, very sharply. So relatively, India is not looking as expensive compared to the world. So at some point in time, I think you will see a lot of global investors allocating money back to India. Point number three, India is entering 2026 with a very strong balance sheet, right? If you remember, over the last 20, 25 years, whenever India has had challenges, it has been the twin deficit problem, right? Either government deficits have ballooned or your banks have been straddled with bad debt, and that finally shows up somewhere in currency, right? In this year, we are entering with a very solid balance sheet. I mean, government finances are decent. Your banks probably have seen the best balance sheet in my entire career, right? So balance sheet is extremely strong. You've got $700 billion of foreign reserves. Your software exports are today more than your oil imports. You have a very strong push from the government to make in India. That further will bridge the trade gap that we have in a lot of countries. I'm assuming that, given the natural alignment of India and US, at some point, we'll create a truce and find a solution to this entire, tariff war. Because see, the absolute number in terms of exportable tariffs to the US is not a very big number compared to the entire GDP. But it's just the narrative and the sentiment which is gone sour after this entire tariffs that have been levied on us. So you're entering 2026 on a strong footing. Even the earnings expectations are better over the next year or so. But really, I'm just marrying it with the longer term backdrop that we just discussed, right? The 5 year story looks good. So still you see a lot of long term money getting allocated. See, listed markets FIs have sold. But in FDI net, we've seen a lot of money coming into India, which means they're still confident about. See, if you're seeing people allocating 5, 10 year money into India because that's FDI money, then definitely there is a lot of conviction in the India story.
Okay, so the fact that you're saying that the tariff issue is it's just the narrative and it's nothing more than that that's unnerving at the moment, right?
It's not just the narrative. What I was trying to say was the number is small, right? But it does impact sentiment and it does tend to postpone some of the investment plans.
Let's move aside from that. And you use a lot of cricket analogies. So I'll bring up one. You said, don't lose your wicket during boring times. So don't do anything adventurous. Just keep going with the singles. Is that what we're going to do for 26 as well, you think?
I think that's what we did in 2025, right? I mean, we had to be careful on our portfolio. I think in the first half of 2026, I think a similar story will play out where you will see a lot of volatility, you will see tariff-led narrative, there is a geopolitics looming, right? So sometimes, I equate it to cricket, right? You have different kind of pitches. You have flat pitches where you can go all out. Then you have tricky pitches of Australia where the ball is very bouncy, right? Where you actually got to hold your wicket. And then you have, different phases in the match as well, right? The beginning overs, the middle overs. I would say we are probably, middle overs right now.
Okay.
Because we are already 4 years into the bull
On a flat
market.
pitch or a tricky pitch?
So middle overs on a slightly tricky pitch. I
Okay.
wouldn't say very, very tricky because things are getting better, but slightly tricky pitch.
Okay.
Yeah.
You have gold in your portfolio, and that has done well. And how? Um, what is your advice in terms of gold as an investment decision for those who've missed the bus, for those who had a super tiny allocation? Where's gold going?
So look, we've always advocated allocation into gold, and I look at it as an insurance in the portfolio.
Okay.
Because what happens is, when equities do badly, gold typically tends to do well. And equities tend to do badly when there is a macro problem, when there's geopolitics looming over, or there is some global issue, right? And during these times, gold tends to shine. And gold gives you the firepower to rebalance your portfolio.
Yeah.
So when you're designing customer portfolios, we typically advise them to keep 10 to 15% in gold. Now,
Okay.
it's incidental that we've always been advocating gold, and last year gold has had a phenomenal year, right? So some of these years just happen.
Yeah.
You don't know when they will happen, right? Now, anybody building incremental allocation to gold should probably do it in a staggered manner after such a big run. And I don't think after such a big year that gold has had, you'll have another big year. Probably we are looking at a single digit kind of an outcome
Yeah.
for gold, if at all.
That's the view on gold, and let it be the insurance in your portfolio.
Absolutely.
And what's
Uh,
interesting,
and just wanted to add that
yeah.
I don't personally have any gold in my
Okay.
portfolio.
Okay.
I have 100% equities.
Okay. Okay.
The only gold I think we have in our house is probably jewelry or
Yeah. So you're thanking
some
your
gold.
wife.
Yeah, absolutely, absolutely.
Okay. Now, what's interesting is that the overall wealth pool in India as well has compounded quite significantly, 13 to 14% annually, and that's significantly faster than the nominal GDP.
Right.
What is driving this acceleration? Tell us a little bit more about the behavioral aspects when it comes to wealth creation and wealth preservation and how that's changing.
So three things. First is I think people are becoming more financially aware.
Yes.
So COVID was an event which kind of triggered it. A lot of us had time. We were sitting at home. You saw the surge in demat accounts. You were less than 4 crore demat accounts pre-COVID. Today you're close to 20 crore plus accounts. So massive financialization underway in the economy. So people are becoming more financially aware. They are learning the advantages of having financial wealth. It's convenient, easily liquidable, easy to track.
Right.
That's point number one. Point number two, you are seeing people shift a little bit from traditional asset classes to equities. At least I
Yeah.
have seen the larger families lightening up on their real estate portfolio and moving to
To
equities.
equities.
But at the same time, they are also purchasing larger houses. So that's a bit of a dichotomy.
Okay.
The third thing is you're seeing a large scale monetization happening in the economy. So because of this entire equity rally and the outlook that we spoke about, a lot of professionals who have ESOPs have been cashing out and creating liquidity. A lot of promoters have been able to create liquidity by going public, or they're taking some chips off the table given that the company's done so well in terms of the stock price and creating family offices. So a lot of this is also driving financial wealth growing faster than the GDP.
Okay. I recently spoke with someone who also manages HNI money, and it was interesting that he said that they are also now looking at some non-traditional avenues. You said equity, and then there's AIFs, venture capital, private equity, things like that. Can you tell us a little bit more about whether or not you're seeing this kind of a shift, what it's typically like when it comes to allocations, and more importantly, what you're advising?
See, this typically happens when affluence grows, right?
Yeah.
If you have a small portfolio and just let's take for an example 25 lakhs, right? Now, you can't do too much with it,
Yeah.
right? The best products for you is mutual funds. They allow you good participation across asset classes in a very convenient manner. But the moment the wealth increases, and that's what is happening in India, right? We just spoke about the fact that wealth is increasing at 13-14%. So as the size of corpus goes up, then you're able to allocate capital to non-traditional asset classes. So for example, a private equity fund, typically the minimums range from 1 crore to 3 crores. Similarly, an AIF, which can give you the ability to allocate to unlisted and listed equities. Now, there the minimums are between 1 to 3 crores. Similarly, let's assume that you want to go and buy a co-invest opportunity in fixed income or even in unlisted equities, right? The minimums can range anywhere between 1 to, in certain very curated opportunities, even 25 crores.
Okay.
So what is happening is the number of family offices are growing. The sheer, number in terms of corpus is growing for many families. So as that is growing, they are looking to more non-traditional kind of asset classes.
Okay.
And we saw this growth in the US as well, and we are witnessing a similar phase.
Okay.
So I would say we are at a very, very early stage here. A lot of
Okay.
these asset classes like private credit, private equities, co-investments, they will see multifold increase. They'll grow much faster than the total wealth investment pool.
Interesting that that's an observation that you're making. But I think when it comes to market philosophies, I mean, there's so many principles in terms of when there's fear on the street, that's the time you need to be greedy, and vice versa. It sounds so easy, but I feel it's so difficult for investors to actually implement and, sort of let your money do the talking, patience. What are some of the classic mistakes that you observe, and what do you think investors really need to stop doing?
I think the number one mistake, and I've spoken about this a lot of times, is rear view mirror investing. Right? You look at past returns and then assume that the same returns will continue into the future. That is the biggest mistake. And we've done this analysis, and I think the entire industry uses our slide where we've ranked the top 20 mutual funds, let's say in this case equity mutual funds, which have done the best over the last 3 years.
Yeah.
Right? And then we have seen how they do in the subsequent 3 years.
Yeah.
You'll be surprised. The number one mutual fund rank falls to something like 150. The number two
Really?
falls to like 78. So mean reversion is a fact in markets and asset classes. And the same thing you can now extrapolate to asset classes. Like the narrative around gold and silver is
FOMO.
probably, yeah,
Yeah.
it's FOMO now,
Yeah.
right? If you don't have gold and silver, then you have to
Yeah.
own it.
Yeah.
Why is that the case? Even last year we had recommended gold, but there was not so much excitement around gold.
Yeah.
The reason there is excitement is because gold has done 60%.
Yeah.
Right? And that 60% is skewing numbers for the last 3 years, for the last 5 years,
Yes.
for the last 10 years,
Yeah.
right? And chances are that if you allocate a large sum of money to gold and silver today with the same expectation, you will end up disappointed.
Yeah.
Okay. So this is the number one mistake. Please do not base your investment decision only on the past 1 year or 3 year performances. Do a little more study on the underlying fund, asset class, preferably work with a wealth manager who can give you perspective and then make your decisions.
Fair. Motilal Oswal today operates in one platform, but there's multiple offerings. So there's not just equities and stocks, but you've got AIS, mutual funds, PMS, commodities. Why is this integrated approach so relevant, especially in today's day and age?
I'm glad you brought this up. I mean, we are a very, very unique institution, right? We are building scale and excellence in all aspects of capital markets, investing, and wealth management.
Okay.
Right? So when you go to a family, you are basically bringing the might of the institution to the family. Because if I were to just chalk out the journey of one of our customers, right? And this is actually a real case. When we met this customer was running a small company, right? They needed capital because they were seeing a lot of growth ahead of them. So we actually got them to meet with our investment banking team. The investment banking team then counseled them on how they should go about the fundraise.
Okay.
Coincidentally, our private equity fund loved the business, they loved the promoter, and they put in money into the company.
Yeah.
Okay. After about 5 years, this company went public, which unlocked capital for the promoter. The promoter did a bit of OFS, some bit of liquidity was taken off by our private equity fund. Now that OFS, the moment the OFS happened, the promoter family had a corpus to invest. We came in as a private wealth manager for the family, designed the entire investment charter philosophy for them, and now we've been managing that corpus for the last 5-6 years. Recently, it's a publicly traded company. The promoter wanted to buy a house, and hence the only currency they have is their stock. So our institutional equity business, which covers the company and publishes a research report on the company, did a block transaction for the customer and gave the customer liquidity into their bank account. And then we help them buy the house because we have a real estate division within private wealth. So now you see how this integrated approach works, right from advising a customer on their business, how to go about a capital raise, to our private equity coming in as a partner for them, and then later on our investment banking taking them IPO,
Yeah.
and then our institutional equities covering their company and then helping them with a block deal. And of course, when they work with us, they also work with our private client group
Yeah.
of the broking division. So really this multi-pronged approach, the customer feels that he has an entire army
Yeah.
of solutions
Hmm.
in front of him or
And a
her.
one-stop shop,
A
right?
one-stop shop.
Yeah, don't have to go hunting.
So we are very unique actually. I can't think of another institution in
Yeah.
India which has all
The
capabilities
proposition
at scale.
and scale, right? I want to talk about your personal journey as well, because you grew up watching your father in the corporate world and your mother as well, pursuing her PhD. Did all of this culminate into putting you where you are and helping you in your corporate journey?
No, absolutely. In fact, I always refer to that speech given by Steve Jobs.
Okay.
You know, everything finally comes together, right? All dots are connected. And I'll give you one example. When I used to go to my uncle's place, right, I think at that time I was in 11th standard, uh, he used to have a lot of books in his house, right? And these were small books. And I asked him, what are these books? So he used to tell me these are annual reports of company. Okay, in those days, he used to buy 1 or 2 shares
Yeah.
just because he gets the annual report. And he introduced me to the balance sheet and annual report because he used to be an investor and he used to write about stock markets
Right.
in a very popular
Oh,
daily.
okay.
Okay, he introduced me to Warren Buffett, and I'm talking about maybe 90s.
Yeah.
That left a very deep mark in my mind. So actually somewhere the seed was sown then that I wanted to do something in investing and capital markets. I was very clear from day one.
Wow.
So much so that I think yeah, my dad's an engineer from IIT, and he was very keen that I become an engineer. But I actually told him that's not for me because
Yeah.
my passion is capital markets.
That's where your passion
And
lies.
he allowed me to pursue it. I think the knowledge bit, reading books, also came from my mom because she was doing her PhD, and the deep rooted belief that knowledge eventually will make you a success came from there. And as I grew in my career, I saw my father very closely as a kid because he was a CEO, right? He used to work with many people. So a lot of those things subconsciously get embedded in your mind.
Yeah.
And I would attribute a lot of my success to, these early years that I've spent with them.
Yeah, you have your grandfather to thank for the annual reports and the
Yeah,
introduction
my
to.
uncle actually.
Sorry, your
Yeah,
uncle to
yeah.
thank for
But
the
coincidentally, my
introduction.
grandfather was also a banker.
Oh, okay. So it's
So
in the family. So no wonder you are where you are. Wonderful. And you've touched upon books a lot and the importance of reading and how knowledge really empowers you. Care to share any books that have had a big impact on you or what you would recommend maybe?
So for anybody who wants to come into equity investing, right, I think the gold standard are the letters from shareholder letters of Warren Buffett, right, from 1964. I've read all of them.
Yes.
And obviously, we've been inspired by our founder, Mr.
Yes.
Ramdev Agarwal,
Yes.
right? He keeps talking about Buffett. So those are actually amazing. And I would also say the wealth creation studies that Mr. Ramdevji has
Yes.
created,
Yeah.
even if someone reads all his wealth creation studies, I'm telling you, it's like a masterclass. And then, of course, the usual One Up on Wall Street by Peter Lynch.
Yeah.
Then you have your, Howard Marks, The Most Important Thing, Illuminated, anything you read on Buffett. Then recently, someone like a Morgan Housel
Yes, I was
has,
just going to
has
say.
written
Yeah.
a lot on behavioral
Yeah.
economics.
I'm underway with his book.
In fact, I have his first 2 books. I was the first to get an interview from him in India. He's
Really?
there on the Motilal Oswal Private Wealth YouTube
Oh,
channel for anybody who wants to
lovely.
watch
Wow.
his first book and the second book.
Good to know.
Now he's released a third book, same as ever. So these 3 books also amazing. And Daniel Kahneman, uh, you should read anything by Daniel Kahneman on behavioral finance. So these would be few books
Interesting recommend.
that I've loved reading.
Great recommendations. And finally, I think for the next generation of investors, professionals, those are who are just starting out. I mean, you've gone through so many market cycles, wealth preservation, compounding your wealth. What would be the 3 bits of advice if you had to nail it down that you would give?
So I think have unwavering conviction on India because this is the country you're born into. And generally, what we are going to see in the next 20 years, we are probably 10% of what we will see.
Okay.
Okay, so
So we
90%
have
is
a long way to go.
ahead of us. Secondly, as I said, starting early is super important. I mean, I can't overemphasize this point because what you don't invest in the first 5, 6 years, you cannot make up by investing more aggressively in the later years. That's how compounding works.
Yeah.
Third, understand compounding. everybody thinks compounding is very easy and at the face of it. But the moment you start doing numbers with them, like for example, if I ask you, 15% compounded, how much does 100 become, right? Probably you'll be able to give me an answer. The moment, I go to 10 years, 15 years, 20 years, 25 years, it's exponential mathematics.
Yes.
Right? Very difficult to fathom what that number will become. And I'll just give you a number. Like if you compound at 20% for 25 years, your capital becomes 100x.
Yeah.
Okay, at 25% in 20 years, you become 100x.
Yeah.
All right, in the next 20 years, you become 10,000.
Yeah.
So
it's exponential growth.
Exponential growth. So understanding compounding
Yeah.
is the basis to any investing. And lastly, but not the least, allocation makes all the difference. So if you're 70% equities, right, and someone else is 30% equities, even if your 70% selection is not great,
Yes.
you will still do better than the 30%. So equity is designed for 12 to 15%, at least in India, in the next many years to come, whereas debt is designed for 7-8%.
Got it. Yeah. So interesting talking to you, Ashish. Thank you so much for opening up and giving us all of your pearls of wisdom when it comes to wealth creation and investing.
Thank you. I've really enjoyed this conversation.
Thank
And I hope, people have takeaways from these conversations.
Oh, I know I certainly have a lot of key takeaways. And I think the fact that Ashish harped on the fact that you need to have conviction on the India story, start early, because what you don't invest in earlier, you will never be able to make up for later on. And understand the power of compounding, it will take you a very long way. So that brings us to the end of this episode of the podcast with Motilal Oswal. And if there's one key takeaway, it's this. Wealth is built by discipline, conviction, and time, and not by reacting to every market cycle. We'll see you next time. Thank you for watching.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.